Jerome Powell refuses to speculate on what Donald Trump's return to the White House could mean for the Fed, but for bond markets, Trump's plans overshadow the rate cut. Welcome to Market Insight. I'm Elena Casas. Fed Chair Jerome Powell said the election result would have no near-term impact on monetary policy after last night's quarter-point rate cut, but the outlook for future cuts has been clouded by the expectation that the lower taxes and higher tariffs promised by Donald Trump would lead to a rebound in inflation. 10-year Treasury yields have risen about 70 basis points since the middle of September as betting odds on Trump improved. Well, to find out what that could mean for the US economy, I'm joined now by Gregory Daco, Chief Economist at EY Parthenon. Gregory, hello. Clearly, Jerome Powell wouldn't be drawn on this yesterday himself, but how would you expect the coming administration to change the outlook for rate cuts in 2025?
Well, I think one of the key elements to remember is that the US economy remains on solid footing. We still have a robust labor market, and we continue to have disinflationary pressures pushing inflation towards the Fed's 2% target. So in that environment, we still anticipate that in the near term, there will be further policy recalibration with another 25 basis point rate cut in December. The key question as to 2025 is how much policy shifts will affect economic activity. I think in the very near term, the first half of 2025, there will be little changes because we're unlikely to see major changes in terms of trade policy or even in terms of tax policy that would dramatically shift the outlook and therefore force the Fed to react in one way or another.
Further down the line, though, how might the Fed react to a resurgence in inflation?
Well, I think if we look back at the last few years as evidence that the Fed perhaps has this bias to ensure that inflation needs to come back to the 2% target, that would indicate that all else equal, the Fed would be likely to adopt a more hawkish stance in an environment where inflation would take more time to revert back to the 2% target. So if we consider some of the policies on the trade front, on the tax front, it seems likely that these would push inflation slightly higher relative to a baseline. And that would essentially indicate that the Fed would be more cautious as it eases monetary policy and recalibrates it towards neutral, really feeling its way as it gets closer to the neutral stance.
Now, Jerome Powell said yesterday he wasn't concerned by the recent rise in bond yields. The 10-year has come down a bit lower today and is around 4.3%. But how concerned should we be, or at what point should we be concerned, that tightening financial conditions could again weigh on the US economy if this continues?
Well, I think there are two things to think about. The first is what is driving the underlying pressure in terms of bond yields. Is it stronger growth expectations? Is it stronger inflation expectations? Is it larger expectations of larger deficits? All of those factors play a role in determining how hurtful this rise in yields can be for economic activity. If we consider an environment where we're seeing stronger economic momentum and perhaps a little bit more pressure on inflation, which would essentially lead the Fed to ease less, those rising yields aren't necessarily negative. When it comes to financial conditions, what we've seen over the last few weeks is actually a rise in bond yields along with stronger equity prices. This combination is unusual and points towards a scenario where we would see stronger growth than initially anticipated. So right now, it's not necessarily a major concern in terms of economic activity, but if we should see prolonged period of time with higher yields and tighter financial conditions, then that would become a concern for the economy and for the Fed.
You mentioned expectations of a rising deficit as one of the factors there, though. Donald Trump's campaign plans would be expected to add significantly to the US public debt, which is already historically high. Can bond market demand sustain this?
Well, I think that's an open question at this point. We know that a Republican-led government will try to essentially extend the Tax Cuts and Jobs Act that is expiring at the end of 2025. We know there are a significant number of demands in terms of additional spending, in terms of various tax cuts. Those all have a cost to them. And we know that there is generally reticence to just spending freely and larger and larger budget deficits. So I think when we consider the policy outlook, we also have to keep in mind that all these measures will have a cost, and there will likely be some trade-offs between different measures so as to avoid a situation where the deficit would rise very rapidly from what is currently an elevated level around 6.5% of GDP.
Gregory Daco of EY Parthenon, thank you so much for that analysis. And that's your Market Insight. Don't forget, you can watch more videos on Reuters.com.